Good day, ladies and gentlemen, and welcome to our class on MACD, moving average, convergence, and divergence. Now, I would appreciate it greatly if you could subscribe by clicking the subscribe button down below or hit the bell icon because subscribers are very important. They help me grow my YouTube channel. Now, today, as I mentioned, we're going to be talking about MACD. And it was developed by Gerald Appel in the late 70s, and it's got a rather grand sounding name, moving average, convergence, and divergence. But everybody calls it the MACD indicator. It's used to spot the strength, direction, momentum, and duration of a trend. And I'm going to say right now in a stock's price. When it was originally developed by Gerald Appel, it was developed for use in the stock market. And in the 70s, that was really about all that we had that we could trade at that point. I sat and I traded commodities in the early 70s, but I sat in the pits and I dealt with ticker tapes giving us the prices, and we didn't have PCs, we didn't have the internet. We had these huge rooms that were air conditioned that used, they were a type of a computer that used those data process, those punch cards that could collate some information, but it wasn't connected to anywhere in the world. We barely had faxes, and we had to rely on these ticker tapes for all of our information. But as the markets grew and online trading grew and people tested the MACD, we found that MACD works extremely well in all markets for all assets, and it adjusts very, very quickly for short-term online trading. So MACD has become one of the most popular Forex indicators. Now you can use MACD to trade divergence, which you can see in the histogram, which I'll show you a little bit later. But MACD works great at generating transaction signals and telling us if the market is overbought and oversold and telling us the strength of the trend. The MACD indicator is typically placed at the bottom of the trading chart in a separate window beneath the price chart. Now I'll show you all this on a live chart. The moving average divergence convergence tool is relatively easy to use. But however, it is crucial to understand it fully before attempting to trade using its signals. The concept behind MACD is straightforward. Essentially, it calculates the difference between an instrument's 26-day and 12-day EMA. So that's basically a moving average crossover, but it goes a lot farther than that. It uses that, subtracts one from the other to develop the MACD line, and then it uses a 9-period moving average of the MACD line to generate what's called a signal line. And the crossovers between the MACD and the signal line give us transaction alerts. Then the MACD histogram is an elegant visual representation of the difference between the MACD and its 9-day EMA. The histogram is positive when the MACD is above 9-day EMA and negative when it's below. It also shows us the depth and the peaks and the valleys of the moves so that we can see overbought and oversold areas as well as possible divergence. The moving average convergence divergence indicator is both a momentum oscillator and a price-based oscillator, and is one of the most reliable studies we have. The MACD is perhaps the best all-around study available. Indeed, this author, myself, considers the MACD to be the best signal oscillator available. It is about the only one I use. As most of you have come to my classes, you know I am a price action, chart pattern, support, and resistance trader. When I can't figure something out or I need confirmation, I use MACD. I don't use RSI. I don't use stochastics. I don't use CCI. I don't use any of them. I don't use Bollinger Bands, not because they're bad. I love MACD, and I only use the one indicator at any given time. So let's go look at a step-by-step presentation that I've built for you on how we put the MACD and how it's derived and placed on our charts.
So as we can see here on our chart, we have my teaching chart, the Euro US dollar, and we're looking at a 30-minute chart. For no other reason, this is what I use to teach from. Now MACD consists of a 12 or is based on a 12 and a 26 period moving average. So let's drop the 12 period moving average on our chart. So now we're looking at the blue line. That's a standard 12 period EMA. Then we add on a 26 period EMA. That's the purple line I just dropped on the chart. Now, there are many trading strategies that are based on moving averages and moving average crossovers. For instance, whenever the purple line crosses the blue line, we would get a buy signal, and vice versa. We would get a sell signal when the longer term moving average crossed above the shorter term moving average. So like you see here, this would have been a signal to sell. Here we would have gotten a signal to buy, but this is just a standard basic moving average crossover strategy. This is just the very beginning of MACD. From here, we actually get rid of these because the first line or the first part of MACD is the difference between the shorter period moving average, the 12 period, and the 26 period. So when they are equal or crossing over, the difference would always be 0. When the longer period moving average, which you'd be subtracting from the shorter period moving average, is larger, it would always be in a negative number, and vice versa. So we simply drop this line onto our chart below, and this blue line is known as the MACD line. It is on a 0 line here, and it is based, the 0 line here, and it is based on the difference of the two moving averages above. At this point, we no longer use these moving averages from above, so we can get rid of them. And this MACD line tells us exactly what is happening. Now, I could put a straight line across here at the 0 so you can see it better. And every time the MACD line crosses the 0 line above, that tells us we have a buy signal because the two lines have just crossed each other because the two moving averages subtracted when they're exactly the same as 0. And the shorter term is moving higher than the longer term because we're using that to subtract the shorter term. So it's a positive number. Now down below here, we got another cross right here. And that tells us the longer period moving average was higher than the shorter period moving average, or telling us a sell when they crossed over here. And as we can see, we're down in negative territory here. See, they're negative numbers. But this is only the second step of MACD. MACD then uses what we call a trigger line. This trigger line is the 9-period moving average of this blue line. It's a simple moving average, and we simply add it on to the MACD line, and it's called the trigger or the signal line. Now, we forget about the moving average crossovers here, and what we have are moving average we have the crossovers of the trigger line and the signal line. So now when the signal line and the trigger line cross each other, they are generating more important buy and sell signals. Okay. So the trigger line triggers a buy or sell alert when it crosses the MACD line. And again, the trigger line is simply a 9-period, or the signal line, either way you want to call it, is simply a 9-period moving average of the blue line that we put on the charts. Then with MACD, we go on one step farther and we add on what is called the histogram. And the histogram is simply a visual depiction of the MACD line and the signal line. So we can see in the green on the histogram, actually, on the green of the histogram, when it becomes green from red, we just had a 0 crossover. And when it moves into green from red, it's giving us a buy signal. And then the depth and the peak of those moves tell us how strong that signal is, as well as telling us if the market is overbought or oversold. So some people, including myself, say that everything you need to know about MACD is included in the histogram. So I don't use moving averages above. I don't use my MACD line. I don't use my signal line because everything I can see right here in the histogram. I can see the crossovers. I can see them very well visually because whenever the colors turn from green to red, I have a crossover below. Whenever the colors turn from red to green, I have a crossover above. So I'm getting a buy and a sell signal. As I get peaks, the peaks and the troughs, the steeper they are, the more overbought we're being told that that signal is. And we can see the momentum waning as the price moves downward. Okay. So this correlated to this movement, although it doesn't duplicate that movement, it's giving you a signal.
So everything you need to see is included in the MACD lines using the center line, the MACD signal line, and the MACD line, or simply using the histogram. The MACD can be helpful for noticing potential changes in the very early stages of a currency pair's move. In an effort to more closely follow the relationship of MACD and the signal lines, traders follow the histogram. As I mentioned, it's an easy way to see what is happening. And MACD gives us three stories. It gives us crossovers, it gives us overbought and oversold conditions, and divergence. Okay, divergence I don't really pay much attention to for any indicator. Divergence is when the indicator is moving in one angle and your price is moving in the other. I don't ever see it, and it's too loosely defined for every indicator. Crossovers are quite obvious. And if you're using the histogram, you see them quicker. They happen at the same time, but your eye just picks them up much faster. And when the histogram moves above zero, it's a buy. When it moves below zero, it's a sell. So I would appreciate it very much if you could hit the bell icon down below and subscribe to my channel. And then we get the overbought and oversold conditions, as well as divergence. So MACD is a derivative of a derivative of a derivative of a derivative. It's a fourth step removed from price. Now remember, an indicator only indicates. The base of this indicator is the securities price, but it takes 4 steps to get the actual price of the MACD histogram. Talk about massaging data. Well, not necessarily a bad thing. Chartists who keep this in mind when analyzing the MACD histogram, it is an indicator of an indicator. Therefore, it's designed to anticipate signals in MACD, which in turn is designed to identify changes in the price momentum of the underlying security. As with MACD, the MACD histogram is also designed to identify all of these pieces of information which I've shown you. You get transaction signals, which are the crossovers. You always want to watch that center line, that zero line, because even though you don't get a crossover, when the indicator starts moving towards that center line and bounces off, doesn't even cross over, it does tell you something about what is happening in price. Now, the thing with MACD is MACD, when it generates the signals, doesn't tell you how long that signal is going to go, how much profit you'll make. So it can give you many signals, and you'll find if you look at them, they are quite right. But sometimes it gives you a sell signal, but the sell was only a half dozen pips, not enough for you to even cover your spread. So you need to understand what you're looking at, because you can get whipsawed in and out of a lot of trades and end up losing on those trades because it doesn't tell you where your target price might be. So the MACD indicator is one of the most popular tools in technical analysis because it gives traders the ability to quickly and easily identify the short-term trend. The clear transaction signals help minimize the subjectivity involved in trading, and the crossovers of the signal line make it easy for traders to ensure they're trading in the direction of momentum. Very few indicators in technical analysis have proved to be more reliable than the MACD, and this relatively simple indicator can quickly be incorporated into any short-term strategy. So thank you very much for joining us today. Start adding MACD onto your charts, and in no time at all, you'll find that you're trading with it successfully. Bye now.